My name is Oriane Parmentier, European rate strategist, and I'm here today with Jim McCormick, Head of Global Strategy at NatWest Markets, and we will discuss key macro themes. The main story in markets in the past few weeks really has been the escalation of the coronavirus. Commodities are down, volatility has spiked from the lows, and China in particular has been hit hardly. There are still many unknowns, so maybe Jim, you could tell us what is your view on how we can assess the impact of the virus on markets?
Yeah, well, we released a note earlier this week, which is on our website, and I guess the simple message I always say around these things is you don't want to be too clever. It's very hard to know what the impact is going to be, how long it will last. But I think if you simplify the question to think about the impact on global growth, it's a little bit easier for us because we can use our global growth framework.
And what is this growth framework?
So the framework is something that we built last year, which is effectively looking at global manufacturing sentiment through the lens of the global PMIs and using that to see where asset prices linked to growth or value.
Mm-hmm. And can you tell us how you use this to assess market impact?
Yeah, so if you think about today's virus, the first thing you need is to find an episode that was similar, which I guess from our perspective, SARS in 2003 is probably the closest that we can see. And if you look at what happened in SARS from a point of view of global growth, you had Hong Kong, which was significantly impacted, going from fairly strong sentiment, so purchasing manager surveys above 50, falling all the way to below 40, and then getting back to 50 by the middle of the summer. So it was a very acute impact that lasted for a short period of time. If you apply that same type of profile to what's happening today, you probably have a manufacturing PMI that goes from above 50, again, like it was in early 2003, to something closer to 45, 46. So a pretty big drop in global terms. And then if you apply that to our growth asset framework, you're talking about an impact on asset prices, say the global MSCI, of at least 15 to 20%. So a pretty big impact. Yeah,
that would be quite a significant shock. Are there reasons to be a little less concerned about the downside risks, you think?
Yeah, I guess there's reasons to be maybe less and more concerned. I think the less concerned is that central banks have been very supportive for markets, and we saw that last year. I guess against that, this time around, central banks have less ammunition. This time around, the center of the stress is in emerging markets rather than developed markets, so you're not necessarily going to get much help from the developed market central banks. And I think the other issue is that markets were not prepared for this. So our own measure of macro implied volatility hit an all-time low Friday before last, so just before this whole thing kicked off.
Mm-hmm. And is there any good news?
I think the key message in terms of good news, there is no such thing as good news from the point of view of the virus, but if it is something like 2003, we're talking about a big hit in a short period of time, followed by basically back to trend. And I think the good news from the manufacturing cycle globally is that we were watching a trend of improvement before the virus hit.
Mm-hmm. And looking beyond the virus, are there any big event risks on the horizon?
Yeah, I think there's always plenty of event risks, but I think for us the key one that is about to hit is the U.S. presidential election, and we've been saying for quite some time that we don't think the market is really thinking about this election in the right way. So we've done a number of surveys with investors in the last few months. We always get the same answer. We ask, do you think Donald Trump will win the election? And the answer is always about 70% yes and 30% no. And we think that it's probably closer to 50-50. And the reason is that although this election is going to be about the economy, the three states that are going to matter most are likely to have very weak economies heading into this election. So it's a 50-50 race with candidates with very different economic ideologies. And I think when the market starts to recognize that, we're going to have some real anxiety in financial markets and probably some anxiety with U.S. businesses.
Mm-hmm. And at the end of last year, we said we were positive on the outlook for emerging markets. Up until the coronavirus story, we had actually quite a good start of the year with notably currencies and equities starting well. What is your thinking?
Yeah, so going back to how we talked about the framework for this virus, if we get something similar to SARS, which is an acute hit to global growth, but a very short-lived hit to global growth, I think the question investors need to be asking is, what do we need to be buying during this period of market weakness? And we look at emerging markets and nothing's really changed. I mean, yes, the virus is a big hit to sentiment, but the business cycle momentum was very strong in emerging markets before this. When we look at valuation in emerging markets, we always point to valuation as being very attractive, and that's particularly true in currencies and emerging market equities. So I think the question for investors with the longer term horizon is, at what point do we want to start buying during this weakness?
Mm-hmm. And turning to Europe, our highest conviction in the 2020 year ahead was that bonds would turn positive again in Q1 2020. Obviously, the view hasn't worked well since mid-January. So what is your take on this?
So I think this is similar to the approach to emerging markets, which is if you step back and put the coronavirus aside, you need to ask yourself, is the narrative around higher bond yields working? And I think the answer is yes. So we're getting clear signs of a manufacturing recovery in Europe, including, most importantly, in Germany. We feel pretty strongly that we'll get fiscal policy in Europe this year, Germany included. And I think importantly, one of the big political risks for the Eurozone this year was Italy, and we've just cleared a very big hurdle on Sunday with the local elections, and the outcome was pretty positive. So, net, we had a forecast of plus 10 basis points for bunds heading into this, and I would say that that's still probably a pretty conservative view of where bund yield should be by the end of this year.
All right, so we will finish on this note and on government bond yields. Thank you very much, Jim. Thank you for listening to us. Stay tuned and follow us on social media.